The 2008 financial crisis was the biggest collapse most of us have ever seen. Nearly $20 trillion in wealth vanished worldwide. Banks failed, people lost homes, and governments printed money to keep the system alive. But the most dangerous thing that came out of that crisis wasn't the loss itself, but the medicine used to treat it. That medicine was cheap money. After 2008, central banks like the US Federal Reserve, the European Central Bank, and the Bank of Japan dropped interest rates close to zero. They wanted people and businesses to borrow, spend, and invest again. The idea was simple: make borrowing so cheap the economy would recover. And it worked at first. For more than a decade, borrowing was basically free. From 2010 to 2021, the federal funds rate stayed under 2%. Because of this, trillions of dollars flooded into the system. Investors, banks, and corporations, everyone borrowed. Debt was cheaper than cash. That long stretch of near-zero rates created a new class of power players: private equity firms. They raised money from pension funds and insurance companies, borrowed billions more from banks, and went shopping for entire businesses. To understand how these private equity firms work, let's go step by step with an example you can visualize. Imagine you are a private equity firm. You have $100 million of your own. You came across a company called Fresh Foods. It's a company worth about $500 million. You would rather not pay the full price yourself, so you borrow $400 million from banks and investors. You create a new company, NewCo, which takes the loan. NewCo uses your $100 million plus the borrowed $400 million to buy Fresh Foods. Once the deal is done, the loan is no longer NewCo's problem. It became Fresh Foods' debt. The company now owes $400 million to banks. Now you own Fresh Foods, and to make it look more profitable, you cut costs, reduce staff, sell off real estate, and maybe raise prices a bit. For a few years, it looks like Fresh Foods is doing better. Profits rise because expenses are down. If the economy is stable, you might sell it for $700 million. You repay the bank loan of $400 million and keep $300 million. Since you only invested $100 million, you just tripled your money. That's the basic private equity formula. Look for a company with steady cash flow, buy with borrowed money, squeeze the company, and sell for a profit. Although it appears efficient, the debt can be a significant burden. If business slows or interest rates rise, the debt doesn't shrink, and usually the company collapses under its weight. A perfect real-world example is Toys R Us. In 2005, 3 major private equity firms bought the famous toy retailer for about $6.6 billion. They used more than $5 billion of borrowed money. That debt went directly onto Toys R Us's balance sheet. Every year, the company had to pay around $400 million just in interest before it could even think about growth. While Amazon and Walmart were racing ahead with online shopping, Toys R Us was stuck paying the bank. It couldn't modernize stores or compete online. It limped along until 2017, when the debt finally crushed it. The company filed for bankruptcy, 33,000 people lost their jobs, and a beloved brand disappeared. Here's the cruel part. The private equity owners had already made their money back. They charged Toys R Us millions in advisory and management fees during those years. They even paid themselves dividends by borrowing more money in the company's name, a trick called dividend recapitalization. So when the company died, the investors who actually ran it walked away with profits, while workers, suppliers, and lenders absorbed the loss. The same pattern has happened in hospitals and nursing homes across the United States. PE firms love healthcare for its predictable cash flow, steady insurance payments, and valuable physical assets, making it perfect for loading with debt. Take a typical hospital chain. A PE firm buys it using heavy borrowing, then sells the hospital's real estate to a separate company, often owned by the same investors, and makes the hospital pay rent to use its own buildings. The staff is cut, nurses handle more patients, maintenance is delayed, and equipment upgrades stop. On the surface, profits look great for a while, but patient care declines, accidents increase, and community hospitals shut down when debt payments overwhelm them. In each case, the private equity firm earns money through management fees, real estate deals, and financial optimization. When the hospital finally collapses, they've already extracted their cash. For more than a decade, private equity firms looked unstoppable because of cheap money. With near zero interest rates, borrowing was virtually free, allowing PE firms to finance massive acquisitions using little of their own capital. They promised investors, pension funds, and insurance companies annual returns of 12 to 20%. On paper, that looked realistic because of leverage. Remember fresh foods? A 20% gain on the company can become a 100% gain on your equity due to leverage. But accounting magic made those returns look good. Private equity firms don't mark their holdings to market every day like the stock market does. They value them internally using models. If the real value drops, they can delay acknowledging it for years. That makes performance appear smooth and safe. Here's where the problem starts: when the cheap money is gone. Interest rates are now around 5%. All those loans PE firms used to buy companies between 2010 and 2021 are starting to mature, and they must be refinanced. Corporate loans usually last 5 to 7 years. When they expire, the company must either repay or replace them with new loans. Because the old loans were at less than 2% and the new ones are at 6%, the cost of debt triples. A company paying $8 million in interest now pays $24 million. Many simply can't handle that jump. Thousands of private equity-owned companies are in this exact position. They have good businesses, but too much debt, and now the higher rates are suffocating them. This is the slow poison, a chain reaction that unfolds over several years instead of one big crash. So why do pension funds and insurance companies keep giving money to private equity firms? Pension funds need to earn around 7 or 8% a year to meet their future payment promises. Government bonds yield 3 to 4. Stocks are unpredictable. Private equity promises double-digit returns and shows curated smooth growth. These institutions like how private equity reports results. Because valuations change only quarterly and are based on internal models, the numbers look stable. On paper, everything looks calm, even if trouble is building underneath. Another reason is reputation and relationships. Big PE firms have decades of history. Pension fund managers rarely want to say no to them. They don't want to be the one who misses out if a fund performs well. So even after some losses, the cycle continues. New funds get launched, more money flows in, and the same leverage strategy repeats. When interest rates were near zero, all this worked for PE firms. Now that debt costs 5 times more, the math collapses. Many PE funds will struggle to show even 5% returns, let alone 20%. Investors expecting easy money will be disappointed, and when they pull out, it could expose how fragile the system really is. This is where the comparison with 2008 becomes chillingly close. In 2008, the crisis started with people who borrowed too much to buy homes. Banks bundled those risky mortgages into securities that looked safe. When homeowners defaulted, those securities crashed, and the entire financial system froze. Today, companies are the ones drowning in debt. Private equity firms borrowed cheaply to buy them, then packaged that corporate debt into products like collateralized loan obligations, CLOs. Those CLOs are owned by banks, insurers, and pension funds, just like mortgage bonds were. The pattern is the same: easy credit, complex financial engineering, hidden risk, sudden repricing. The only difference is where the risk sits. In 2008, it was in the banking system. Now it's in the private funds and credit markets that regulators barely see. Back then, when interest rates changed and things blew up, the government could bail out banks directly. But if this private equity system cracks, there's no clear way to rescue it. You can't bail out thousands of private funds scattered across the globe. The risk is also larger in size. Global corporate and private market debt today is 3 times bigger than the US mortgage market was in 2008. And both bubbles are built on leverage, borrowed money stacked on borrowed money. The only difference is speed. The 2008 housing bubble burst fast. 1 year of panic and it was over. A private equity crisis will move slowly. Companies won't all fail at once. They'll suffocate one by one as their old loans expire and new ones become too expensive. If interest rates stay high for another 2 or 3 years, thousands of mid-sized firms owned by private equity could go bankrupt. Pension funds would see massive shortfalls, forcing them to sell public stocks to raise cash, pushing stock markets down. That's how a private crisis becomes a public one. To understand why this cycle keeps repeating, we have to accept a hard truth. The financial system rewards debt and short-term gains, not stability or long-term value. Private equity didn't invent leverage, it just mastered it. If central banks cut rates again, it might delay the pain, but it won't remove the danger. The debt will still exist, it'll just be extended further into the future. That's what happened after 2008, and it's what has built a private equity bubble in the first place. The pattern is clear. In 2008, homeowners couldn't pay their mortgages. In 2025, companies won't be able to pay their loans. Different borrowers, same outcome. What makes this time scarier is the opacity. Nobody really knows what private equity portfolios are worth because they're not traded on open markets. Losses remain hidden until a company defaults or a fund collapses. So, when you hear that global debt is at a record high or that pension funds are diversifying into alternatives, remember what that really means. It means the retirement money of teachers, firefighters, and nurses sitting inside private equity deals is trying to survive. If rates stay high, that money could vanish the same way housing wealth did in 2008. The only difference is this time, it'll be quiet bankruptcies, layoffs, and shrinking pension statements. The lesson from 2008 is that when systematic leverage and opacity break, personal discipline is the only shield. To mitigate the risk coming from the PE crisis, there are key steps to stay safe. Keep your personal debt low, build some cash reserves, and avoid locking all your savings into complicated or private investments you can't understand or access. During turmoil, liquidity is power. Hard assets like gold and silver have also protected wealth for centuries. When confidence in paper assets falls, their prices usually rise sharply. A small portion of savings in gold or silver can act as insurance when everything else crashes. In short, stay light, stay liquid, and hold something real because every time the financial system resets, those who kept discipline and tangible value walk away stronger.